I've helped hundreds of startup founders raise investment, from pre-seed all the way to Series A and beyond. And trust me when I say that when investors take you seriously, everything changes. The meetings are shorter, the negotiations are easier, and the money comes in faster. But most founders never get there. Not because their business isn't good enough, but because they don't know how to set things up in a way that signals to investors that they're worth investing in. So in this video, I'm gonna break down the 7 things that make investors question whether you know what you're doing and how to fix each one so that you can raise the capital you need to grow. Let's dive in. Number 1, you're not a Delaware C Corp. The first thing that will make an investor not take you seriously is if you're not a Delaware C Corporation. Not a California LLC, not a Wyoming LLC, not a Florida LLC. They expect a Delaware C Corp. Now, why Delaware specifically? Delaware has over 200 years of case law, and predictable law means predictable outcomes. So it gives the greatest level of shareholder liability protection, meaning it's become the industry standard that VCs are familiar with. And C Corps have stock flexibility that LLCs don't have. You can offer equity to employees, consultants, and advisors in the form of NSOs, which are non-qualified stock, ISOs, incentive stock options, and restricted stock. And you can create preferred stock, common stock, and different classes of stock. So LLCs are more limited in the types of equity they can issue. So the solution is to incorporate as a Delaware C Corp from day one. If you've already started as an LLC, you'll likely have to convert once you start fundraising. I have a full video explaining how to register as a Delaware C Corporation, so make sure to go and check out that video if this is something you need help with. 2, your founder stock wasn't issued properly. One of the most important things investors look for is that the stock is actually issued to the founders. Now, you'd be surprised how many founders never formally issue their own shares. But why does this matter to investors? It's because if the stock isn't formally issued, you don't own your share of your company. Without issuing the stock, it can't be subject to vesting, which ensures that you stay with your company to earn your ownership in your company over time. It also signals that you don't have your legal house in order. And if you waited too long to issue, you may have tax problems because you want to issue your shares as early as possible to get tax benefits. When you first start your corporation, your shares are going to be worth 0.000001, and as time goes on and you build value, the shares will increase in price. So the benefit of issuing your stock early is you pay less taxes. And make sure you have your 83B election filed. This has to be filed within 30 days of issuing your stock. If you don't file it, you're going to get taxed more than you should. Without 83B, you get taxed when the shares vest, and that's a 22 to 37% tax rate. With 83B, you're taxed at the time of grant when the value is basically zero. So for example, if 4 years go by and your shares are worth $1 each when they vest and you have 1 million shares, that 37% tax rate is going to hurt. That 37% is also only the federal tax rate, which doesn't include the state tax that may apply. You should start with 10 million shares when you start your Delaware C Corp because this is an industry standard for startups and it gives you flexibility for future investors, equity issuances, and employee equity plans. And make sure you have proper vesting in place. 4 years with a 1-year cliff is standard. By the way, if you're serious about raising investment and you don't want to make a legal mistake to kill your deal, click the first link in the description to book a free consultation with me. Anyway, back to the video. Number 3, your IP isn't secured. What is an IP assignment? An IP assignment is a standalone contract, usually called a proprietary inventions assignment agreement or a confidential inventions assignment agreement. And this contract says anything you create for this company is owned by the company. And this matters to investors because if the company doesn't legally own its intellectual property, such as the technology that's been created, what are they even investing in? Anyone who's contributed to your product could potentially claim ownership to that IP at some point in the future. I've seen acquisitions fall apart because an early employee never signed an IP assignment. So you need to secure it from anyone and everyone who works works for the company from day one. All founders and employees, as well as contractors, consultants, vendors, suppliers, if your girlfriend gave you an idea that you incorporated into your company, she's going to have to sign an IP assignment. And here's why this matters. Anyone who hasn't signed can potentially claim ownership to that IP at some point in the future. Your company may not legally own its core assets without these agreements. So be careful, especially with outsourced development agreements. Who owns the IP? Number 4, your data room is a mess. Another reason investors won't take you seriously is if your data room is a mess or doesn't exist at all. All of these things need to be included. Certificate of incorporation and bylaws, shareholder agreements and founder stock, IP assignment agreements, customer contracts, financial statements and projections, cap table which includes all promised equity, documented or not, board minutes and consents, employment agreements and offer letters, option plan and option grants. And there are lots of reasons why this matters, such as the investor is assessing the state of your legal health. If the investor's lawyer sees shoddy legal work or a messy data room, they're going to go tell the investor to do more due diligence. A messy data room slows down the deal and raises red flags. It makes the investor wonder what else is disorganized in your company. Plus, make sure that you have none of these red flags which investors are screening for. Messy, undocumented, or oversized equity promises. Compensation that generally isn't market standard, like paying $500,000 salary to a CTO when the company has only raised $2 million in funding. Outstanding founder disputes, poorly documented contracts, unrealistic financial projections, dishonesty or lack of transparency, and having a tight-knit, organized data room will actually help you get your investment faster and secure it with greater probability. 5, you don't know basic fundraising terminology. One of the simplest reasons investors won't take you seriously is if you aren't using the right words. Investors can tell within 5 minutes whether you understand what you're doing. And if you can't speak intelligently about your valuation or safes or valuation caps or discounts, they'll assume that you'll make rookie mistakes that'll cost them their investment because it signals that you're not ready to handle their investment. Now, thankfully, it's an easy solution, and all you need to do is to learn the terminology. Make sure to refer to your fundraising round correctly. If you say you're raising $5 million for your angel pre-seed round, you won't be taken seriously. Each stage of your startup has a corresponding fundraising round. Angel pre-seed is for pre-launch, pre-revenue, and typically is for raises totaling $500,000. Seed funding is for finding market fit and is typically for raises up to $2 million. Series A is growth stage, post-market fit capital, and is for raises starting at $10 million. Make sure you understand these things. Make sure you also understand pre-money versus post-money valuations. Pre-money valuation is your company's valuation before investment is received. Post-money valuation is your company's valuation after investment is received. Make sure to ask investors when discussing valuation if they're referring to pre-money or post-money valuation, because the same $10 million check at a $40 million valuation means 20% ownership if it's pre-money, but 25% if it's post-money. Learn the 3 main fundraising instruments before you pitch. First is a SAFE, which stands for Simple Agreement for Future Equity. This is a template contract developed by Y Combinator. Most rounds under $2 million are done with SAFEs. You need to understand key terms like valuation cap, which caps the valuation at which the investor's money converts. The lower the cap, the more equity you're giving away. And discount. If you raise at a $10 million valuation later, which prices your shares at $1 per share, but you gave the investor a 20% discount, that investor's shares would convert at 80 cents a share because of the 20% discount. Second, convertible notes. These function as loans that convert into equity. They carry interest, usually 4 to 8%, and have a maturity date, usually 18 to 36 months. They're typically used for bridge bridge or in-between rounds. Third are priced rounds. These are usually at seed stage and beyond, and this is where an actual valuation is set and negotiated. There's higher legal costs, more negotiation, more due diligence, and it involves term sheets and stock purchase agreements. Check out my other video where I go in more depth into all the fundraising terminology you need to know. You also need to understand SEC requirements. Raising funds is considered a sale of securities. You have to file a Form D within 15 days of getting your investment contract signed. If you don't, investors can take their money back, you can get fined, and you can get banned from ever raising investment again. 6. You're over-reliant on fundraising as a business strategy. Another big red flag to investors is if you're over-reliant on fundraising as your business strategy. Sometimes I talk to founders and ask them, how are you going to make money? And they'll say, well, we'll just raise 3 or 4 rounds and then we'll figure it out. And that's simply not a business strategy. It's pretty obvious why this matters to investors. They want to see that you have a real plan to generate revenue. If your entire strategy is just to keep raising money until something works, that's a massive no-go for them because it tells them you don't really understand your business or your market. So you need to have a clear path to revenue that doesn't depend entirely on raising money. Show traction if you have it, customers, revenue, growth metrics. Demonstrate that you understand your unit economics and how the business will become profitable. Fundraising should accelerate your growth, not be the only thing keeping you alive. 7. You've given too much equity too early. The final thing which would stop investors from taking you seriously is if you've given away too much equity already. Now, why does this matter to investors? When you see a founder who's given 50% of their company to a software developer who's just going to write code for an MVP, that's a sign of an inexperienced founder because it tells investors you don't value your equity and don't know how to properly leverage it as an incentive tool. And if you've already given away willy-nilly a majority of your equity before you even raise, investors are going to be concerned about you unnecessarily diluting them in the future. So avoid making your cap table crowded and messy because it's unattractive for investors. Be smart about every piece of equity you give away right from the start. Think about what role each person plays and what the market rate would be if you paid them in salary. You definitely don't want to give away more than 20% of your equity in your pre-seed fundraising round or really any funding round. The equity you give out in the early days will compound as the company grows, so treat every percentage point like it matters, because it does. One of the biggest regrets experienced founders have is not treating their equity as more valuable in the early stages. And of course, always make sure to use vesting too, because if someone leaves early, you need to be able to get that equity back. But here's something a lot of founders don't realize. You can actually buy back even vested equity. So this is something we often help founders with the process of because doing it correctly is important. So make sure to work with an attorney. Now, if you're a startup founder who's getting ready to raise money and you don't want to figure this all out on your own, click the first link in the description to book a free consultation with me. In that call, we'll look at where your company is right now, identify any legal gaps that could scare off investors, and give you a clear roadmap to become investor ready. As a lawyer who focuses on working with startups, I've done this dozens of times already, and I'd love to help you as well. So again, click that first link below to book your free consultation. And if you want to see how one company raised $11 million in Series A funding and avoided some legal mistakes that would have been detrimental, then watch this video next.